I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. I really enjoyed recording this podcast. That's probably because since I last spoke to Mark Wheeler a full 3.5 years ago, he's been able to execute and begin to reap the rewards of all the plans he laid out in episode number 99. There's nothing like a sub-80 combined ratio to put a spring in your step and validate the vision you had when you founded the business, particularly when it comes relatively early in a startup's life. Mosaic has now built out its global platform and wrote over $660 million in gross premiums in 2024, with that number set to grow as the group continues to scale. This interview distills Mosaic's highly specialist added value underwriter-led philosophy in excellent detail. But at its core, this podcast is really all about a real Lloyd's expert making the most of all the advantages of the market's unique, syndicated underwriting and capital platform. It's about the deep understanding of risk and the many shades of diversified capital that risk can be connected to create a sustainable, ultra-specialist insurance business. Mosaic has its own capital, third-party capital, specialist reinsurance relationships, and a large group of syndicated insurance partners underwriting alongside it. It's highly diversified and is set to diversify more. It's capital efficient, but certainly not capital light. Today, this is an almost unique model, but at the same time, it will be a very familiar one to anyone who knows Lloyd's longer-term history. As the market splits into leaders, followers, and data-heavy portfolio managers, here's as good a summary of the 21st century lead underwriter model that you're likely to hear anywhere. Mark is a charming guest, and this is one of those interviews that just crackled along of its own accord, without prompts. I can highly recommend a listen. Enjoy the podcast. Mark, welcome back to the Voice of Insurance. It's really great to see you again.
It's great to be back. Thanks for inviting me. But a second time. I'm quite flattered.
Well, I think sometimes, particularly when there's a new business, you're moving much faster, so your business has changed hugely since we last spoke. So why don't you give us a bit of an update on where you've got to in this Mosaic project?
You must never use the word project with us.
Is that a dirty word? Or?
But it's more of an odyssey or a crusade or a noble quest to change the face of specialty insurance.
So a project implies that it will end, I suppose, doesn't it? And a crusade may be something that will go on forever. There will be new
it's less personal, isn't it? It's got less
windmills
spirit
to tilt at and on
exactly.
The horizon.
But the essence of the question, so I think it was 3.5 years ago, you said, well, we've just changed so much since then. That was our first year. And I think when we met, we'd been operational for about 7 or 8 months from commencement. So we hadn't started underwriting really until well into the second quarter. So we laid the foundations. We had what we thought was a great plan. And that's what we talked about then. So the last 3.5 years have been about laying that out, I suppose. So we planned to be in 7 countries. We planned to have 7 products, and we are in all of those now. We reached that place quite quickly, actually, probably within 6 months of our conversation. We had about 70 employees. We've got about 220 now, so there's 3 times as many Mosaic people here. And I think that's one of the greatest things about the firm. We've got some amazing people here. And the revenue's grown a lot as well, much greater than that, thankfully. So our CAGR at the end of last year, finishing 2024, was 60%. And the GWP has grown about 6 times as well in that period. So that's a good ratio between...
And CAGR's compound annual growth rate for anybody who's not a CEO.
I'm sorry, it is. It's a good number, though.
And yes, and so where have you got to in terms of numbers?
So last year, what was booked, we wrote about $660 million across those 7 lines. And that was round numbers, 25% growth. But more importantly, I think the thing that we're much more proud of is we closed the syndicate last year with a 79% combined. So getting the growth and the profit is what it's all about for us. So the profit bit was key.
Obviously, it's so difficult at the beginning. Obviously, you've got all the ramp-up costs and your expense ratios looks a bit silly. So it's nice when you sort of mature coming through year 3 or 4, you can suddenly get the benefits of all that scale.
Yeah, it's quite quick there. We just missed the top decile in Lloyd's, which is really irritating. I think we were 11th.
Well, if you keep growing and keep growing into profitable business, hopefully you should get there.
It's a very good direction, I think we'd say.
Would you say you had the plan to build the musical, is it 7 Brides for 7 Brothers, that 7 products in 7 countries? Do you feel that you've built what you needed to build, or are you going to continue to build? Should we expect to see, for example, an 8th office, a 9th hub, or that kind of thing?
Well, as I say, we're in 7 countries, and that was the original plan. We chose those locations very carefully because we felt that it would give us access to somewhere north of 80% of Inkscape business for us. So, I mean, that's a phenomenal footprint in that sense.
The real 80-20 rule, go straight for the 80.
Yeah, exactly. And so they were carefully chosen. Our real focus in the immediate future is to go deeper in our existing products in the US market in particular. So last year we hired Toby, and he's come on as CEO of the Americas, really with that mandate. When we met in 21, I don't know what the number is, but probably 75 or 80% of our staff were in London. This is underwriting staff. That number's now probably about just little under 50 for London, and about 35% of them are in the US. I mean, that's just an indication directionally of travel, and that trajectory will continue. Yeah, so we're going to do more in the US in the immediate future.
Out of that 660, how much is sort of on your own capital and how much is on behalf of others?
It's about 50-50. So, as you know, we have really 2 capital pools. One is our own capital in Syndicate 1609, and the balance 50%. And this is another thing that's really changed since we last spoke. We now have 27 underwriting partners or clients who sit alongside us on everything we write. So in terms of volume, it's about 50-50. Looking to the future, we would expect the partner volume to grow as we increase the syndicated market share that we want to bring forward and put on the table. And ultimately, our original plan anyway, after looking at 7-10 years, was that we would retain 20% in 1609. That all comes back to alignment with our partners. So I think that would allow us to always be the biggest line on the slip at scale. 20% would be a big line, and maybe we'd have the next 1 or 2 partners might write that sort of amount in a specific product in a specific territory. But it's a real scale to show the alignment. That's the key.
I think your model's almost unique because you can't say this is capital light, but it's not 100% capital. It's not that you want to have 100% everything on your own balance sheet.
It's absolutely not capital light. It's just not all ours. So, dollars are dollars.
I mean, obviously the capital's still there. And also you'd increased, I was poring over those excellent syndicate results, and it was interesting seeing about the increase in whole account. So it seems that, a lot of people, when they're buying reinsurance, they're particularly proportional reinsurance, and saying, well, goodness, I hate ceding away these profits. I want to be able to get big enough so I can retain more of that myself. Thank you very much.
Yeah.
But you seem to have a different attitude to that. Sort of, well, we've got partners and we want to keep everyone, we'll stay together. Of course, I'll cede them profits and then they'll stay with me.
Yeah, exactly. So you're referring to the whole account quota share,
yes,
I think.
But also the idea that you don't necessarily want to keep everything to yourself. That's the point, to understand that you're part of a market and you're
exactly.
working for other people.
Well, by definition, it's at the heart of syndication. And I don't know if we're allowed to name partners or if I should, but the leader...
Only you will know.
I mean, I'm happy to. So the lead of our whole account quota share is QB Re. We've done business with the individuals there for 3 decades, which is a fabulous continuity. But the real importance is your point. I'd express it slightly differently. And reinsurance is just capital to us. It's just capital under a different name.
Ultimately, we all work for somebody else, don't we? Even if you're the CEO and you are very, very important. But also, ultimately, you've got investors and you're working for them. You're hoping to give them a return on that investment. It's not all your own money. So there are only very unique businesses where you also own all the capital. Your capital, it's still not really your capital, is it?
It's not, but there's an interesting quirk in that. So, if you take any of the big multinational companies, people underwriting it's not their money either. So, in fact, the reality is every single person at Mosaic is a shareholder. So every single underwriter has a share in our FAL, and it's personal to them, and it's personal to each other. And we spend a lot of time curating our SCM partners and our FAL partners, and it becomes personal. And I don't know, there's a separate law for trustee, and we're trustees and it's personal. So we know our shareholders, we know our capital providers have got a face, and it drives the behavior.
You were mentioning about the syndicated models, which are really interesting. Obviously, you're writing on behalf of yourselves and lots of partners and aiming for this sort of 2080.
Yeah.
A lot that's going on in the London market seems very particularly exciting. Digitization, this automatic follow. You mentioned QBE there, obviously big drivers in a lot of this smart follow, tracker, whatever we want to call it. It sounds like this is going to play really well into your strategy of where you want to be incredibly
expert in a small number of things and then be able to wield the market behind you, recognizing your expertise.
That was a big part of our original thoughts and the DNA of the firm. And it's starting to be talked about a lot more now. But there is a secular change going on, particularly in London. And we've got to work out how that plays out. I think it's slowed down because there are so many deeply entrenched interests that are resistant to the change. And we probably don't want to get into that. We know what that is. But we are very clear in our mind.
I suppose the market will always decide these things. And those interests, any deeply entrenched interest with the power of the market will just sweep it away.
Yeah, ultimately efficiency will win. And I think what that looks like, particularly for London, because of the nature and the subscription market, is that in a relatively short period of time, we are going to have a clear demarcation between market makers, if you like, for a broader vernacular, and we're going to have a set of capital that picks their market makers. But the market is speculating today that broker facilities will tap out at about 30%. I don't know whether that's right or wrong. It seems like a good logical number. They will require market makers. That's not our model. We're an underwriter's underwriter, and other underwriters, we work with them, source business for them.
It seems, because that's not what you're here for. You're here for the specialist, transactional liability insurance, all that kind of thing.
I can see broker facilities emerging in most lines over that period, but there'll be different choices. Capital can choose very data-driven broker facilities, but they'll still need a market maker, or they can choose underwriter-led books of business. I think there's a clear choice there. They're very different. They're hard to mix. And very candidly, I don't know why one of our syndicated partners would want to pay us to access the Aon facility, for instance, as probably the highest profile one.
Why would adding a layer on a layer?
Yeah,
that doesn't need to be there.
We have no interest.
That's good to get to the heart of that.
And the specialist capital that's evolving to specifically support, I think, underwriting-led facilities as well. And we have some of them on our panel. And of course, there need to be alternative market makers because a broker still needs to get a consensus. So that's why I say maybe that's half the market.
Well, ultimately, the clients will also decide. They know that.
I'm so pleased you said that because people forget that. It's a client choice and it's a trust thing.
The client together can say, well, I do need an alternative lead.
Exactly.
If you suddenly decide you don't want to write this class anymore, or you've had enough of it, or something went wrong, you need an alternative, and probably an alternative, at least, well, probably two alternative leads who are really strong and, with the service capabilities to service the claims, to lead the claims handling, etc., all the things that you need to be successful as a lead underwriter.
Yeah, and I think that succession point it's not just what I think, it's a well-established point that's one of the attractions of London.
And if someone were using sort of broker vernacular, if someone actually did block the market, then the market would find a way around it. So the market wouldn't tolerate that.
Yeah.
It would say, what if you suddenly became, because you'd got everybody on earth to follow you in transactional liability, and you had this $2 billion line that you could swing whenever you wanted.
Well, the world would be a much better place.
But then, of course, no one would tolerate that. They would say, well, hang on a minute. You can't monopolize this market. You can't just go around dictating the price and doubling the price of everything because you're in a bad mood this morning.
Yeah.
We're not going to tolerate that. Before you know it, there'll be another $2 billion facility following another underwriter who the brokers are really supporting and getting behind. And before you know, that monopolistic position will never be held, will it?
I totally agree. And there may be temporary extreme disruptions, but over time.
Some days, yes, you probably do wake up and you're in a monopolistic position, but that happens so rarely that you kind of got to make the most of those moments, and because you'd be
the last person holding the baby, probably. You probably wouldn't want to be. What does everybody else know?
You just moved into environmental liability. In fact, in another interview you gave recently that I thought was a very good one, you almost went through the methodology of how you find a class that you think Mosaic should be investing in and going for. If you mind going through that again, that was really interesting.
Yeah, sure. So when we set up the firm, we started with a blank sheet of paper. And the purpose of Mosaic is to connect capital with risk. So we had to think about what does capital want? And it's a really healthy place to start. And the first thing that we decided and very clear on and full conviction was we're not going to write any Nat Cat. And there are plenty of amazing businesses that write Nat Cat and lots of them at home for me in Bermuda. And we just had nothing to add to that.
They're actually going out to write Nat Cat.
Yeah. So we didn't want to do that. And I think one of the interesting corollaries of that is there are very few specialty underwriters of scale that don't write Nat Cat. So from an investor perspective, it's really interesting. And the diversification that other underwriters can get from supplementing their portfolio with our business is very efficient on a capital perspective for them in their portfolios. That's quite amazing, some of the results there. But anyway, no nat cat. So what are we going to do? And we said, we're only going to write lines of business that have a very high technical barrier to entry because other underwriters are going to be paying us as they are our clients to access a business for them. That was rule number one. The second was we'd only write lines of business where we could show the team had delivered an underwriting combined ratio with an 8 handle or lower over the cycle. You remember in 2021, it was a very different market. Lots of people are excited about some lines that have fizzled out since. And indeed, they were interesting from an opportunistic perspective at that time. But our pitch to capital was, this is about a cross-cycle value play. So that was limiting. And then we also said we were only really interested in lines of business where the underlying exposures were growing faster than normalized GDP. And that's a great proxy for product growth because something's great.
And it's a great proxy for demand to know that this product will always be in demand. And if your product's in demand, you can probably price it.
And the good news is we've got really strong product demand in certainly 6 of our 7 lines. Maybe talk about that in a second. But those last 2 points were very important for us because we wanted to have the conviction around a portfolio which we should expect to outperform the market on growth and profit. So again, it's the growth profit symphony that we want to deliver.
So with environmental, that works from that perspective.
Yeah, Toby's a former colleague. We worked together a long time, and he worked with Mitch at Ironshaw. As you know, Ironshaw became one of the global lead and largest, most profitable environmental underwriter in the world. So it was an obvious step for us to enter that class of business. And indeed, as I said earlier, it was one of our original 7. When we started, the TL market was absolutely going gangbusters. So we decided to allocate the resource that we'd attributed to that, to environmental, to TL, and made a much bigger investment there and got out of the gate really quickly. Interestingly, you're talking about portfolio construction, that's a tough market to work in, and underlying deal flow is down significantly, compound, year on year.
This is transactional liability,
yes,
all the reps and warranties and all the other things.
Yeah.
But that is certainly has been something that probably, if we were talking 8, 9, 10 years ago, it was seen as a bit of a gold rush, but I presume it's had the sort of situation where a lot of capitals come in chasing that business.
There's a lot of capital, and the structure of the market's interesting. The people in it are not necessarily all dyed-in-the-wool underwriters. There's a lot of lawyers running business.
They're all lawyers,
and
aren't
there's
they?
some
Yes.
excellent examples of that. I think Euclid is a phenomenal business, and they've built a fantastic franchise. Before that, Jeff and Jess Pryor at Ambridge built an amazing franchise. So yeah, I mean, it's work, but there's a lot of stress in that market at the moment, and we're navigating it carefully. There's really 3 pillars. There's reps, there's tax, and contingency. We've been very strict on the contingency front and haven't picked up any losses there at all. And you'll have seen in the press.
Yes. It does sound like some very, very wonderfully broad terms and conditions. I would love to be a buyer. Good to be a buyer when you can buy incredibly broad terms.
I had lunch on Monday with a private equity firm who said they weren't buying because it's too expensive, which I thought was weird.
It's never going to be cheaper.
It's never going to be cheaper. I've been around this market since the mid-90s, and rates are very competitive, and we're calibrating the portfolio accordingly. We'll write less income than we expected this year. We'll put more emphasis on different areas. I don't want to get into the secret sauce, but we've got very, very clear plans about what we will and won't do.
That you know your book well, and you know you're continuing with the good parts of it, and leave the frothier parts for other people to consume.
Yeah, so we're tapering back a bit there, but at the other end of the scale, if you look at something like our political risk book, unsurprisingly, in Q1, that is up over 450% year on year. So it's more than
underlying
offset.
demand. I was just read a story about underlying demand on the tube ride in today.
Yeah.
Underlying demand up at least a third.
Yes.
I mean, I don't know how you measure it, frankly, but it's up. We know it must be up.
Yeah. It's not really surprising, is it?
You've got that emphasis on having that through-cycle track record. What about innovative classes? Because obviously we can't have a cross-cycle, through-cycle track record because it hasn't been around long enough. I'm doing lots of interviews talking about all the net zero transition.
Yeah.
Again, one presumes certainly they're going to fulfill most of those criteria. Certainly they're going to grow it faster than GDP. Absolutely, that there's going to be demand for all these new products. And it sounds like the sort of products that are going to play to a lot of your strengths and the skills that something where you can have as value-added edge, and something that requires a lot of investment that's difficult to replicate, and skill, where you have to really invest to really get to the bottom of the risk. There are things like the insurance of carbon credits, for example, might work for you because of, obviously, if you're already in political risk, it's adjacent. But there are so many other things.
So at the end of the day, the exposures all existed before. They're just manifesting in different places in a different sector, and maybe at different speeds when you add technology in it. So, if you take net zero, off the top of my head, it pretty much touches, I'm going through the 7 divisions quickly, 6 of the 7 for sure.
Yeah.
I'm not sure if I'd say it touches cyber, but in our political risk book, we've had a new product.
I suppose everything touches cyber anyway.
Yeah. Political risk, we brought out a blue bond product, which was enabling developing countries to tie commitments to environmental improvement with easier debt access. So then that very much ties into the transition piece. We have tax credits in the TL team. Of course, we insure environmental engineers. We insure solar panels. The list goes on across the group.
Yeah. And I would say actually cyber, one of the exposures there is going to be in the smart grid, when practically every household becomes also a generator as well as a consumer of electricity, and a storer of electricity as well, and perhaps in the battery of their car or the battery they've got also as part of their solar setup. Then again, the intelligent software, incredibly intelligent software around that is going to be quite complicated because it has to be so connected, of course, that there are also privacy issues. Whereas normally the grid goes as far as the meter.
Yes.
But now it's going to be going right into your home and saying, well, I need to switch your battery on and switch it off, and I need to start. Actually, at times I'm going to pull energy out of your battery, and other times I'm going to be storing energy in your battery, and you won't really be aware of what the hell's going on half the time. And so there are privacy issues, and also you could certainly have sabotage with sort of someone threatening to set fire to every home because they're going to overload the batteries in every house.
That's
impressive. I've got a feverish mind. I'm thinking of all the bad things that could go wrong. So there's definitely cyber exposure there.
There definitely is. I mean, there's all sorts of problems there, isn't it? Now, I'm just thinking about the conundrum of how you even distribute that. But it also sits across lots of different policies as well, doesn't it?
Yeah, I think, again, so that's something where unifying different classes and sort of straddling different silos, the smart underwriter of the future is going to be able to solve these problems and de-silo their business and say, well, this is what the client needs, so let's just provide that and stop worrying about which department it belongs to.
Yeah, the size of populations and the distribution side of that, and does it become part of the homeowners, I suppose, would make the most sense.
Market softening, because it has to sometimes. How's everything holding up? And there are some soft markets where it's almost like we're falling off a cliff because the submission's not here. In the old, more physical marketplace, you could actually see it, and I could feel it as a broker.
Yeah.
I went away for a couple of years. The market really softened. I came back, and when I walked around Lloyd's with a slip, underwriters were suddenly sort of looking at me rather longingly and wondering what was in my slip because it might have some premium.
I think that's just personal. Underwriters never have it, but I'm sure they were with you.
Well, because before they were too busy because they had a queue of brokers and they had their heads down.
So if I remember, you broke DNA, didn't you?
Well, no, just a bit of almost anything. It was mostly liability business for utilities.
I can't believe anybody was pleased to see you then. It must have been
No, absolutely not. Certainly the Spanish grid shut down only 2 weeks ago, and we haven't got anywhere near to working out who's liable for that, by the way. It's going to be quite painful. I'm sure it was God's fault. Well, I kind of hope. I think most people got their fingers crossed and hope that it's some sort of force majeure. But certainly, yes, I'm sure there will be a lot of arguing about that. But there you are. I'm very glad that I don't have to broker that anymore. But are you getting the flow? Because, yes, the worst of soft market is suddenly when the demand's not there, and then there is nowhere to go. It doesn't seem to me to be that sort of soft market. There seems to be plenty of submission. There's still demand for insurance. It's just the market is allowing that insurance to be done at a slightly lower price.
Yeah, well, I can only speak for our data, and our submission flow is up materially, probably up about 35% in aggregate across all of the businesses. But part of that's a factor that we've just turned 4. So we're managing to reach a much wider audience. Part of it's the point about very intentionally seeking out growth classes. And another part is this point about investing in the US and investing with teams in our geographic locations.
It takes a long time to ramp things up. And you plant flag, but it takes at least 3 years for people to even realize that you're there and then remember what you do. And then they start sending you things, and then they may have a good experience, and that's great, and they'll send you more things. But it takes about 5 years, really. Yeah,
it probably does. And market engagement is a big part of how we deal with that and drive the submissions. We've got some areas of the account where we're still getting rate increases, but in aggregate, rates in our portfolio probably off about 5 or 6 points this year. I think might need to adjust that with the inflation outlook, but that's the sort of realm. I think there's 2 really important points there. Most of our syndicated capital partners or clients are based in London. So we're offering something very different there in originating business in these other places. I think it varies from an alternative distribution line for them, or indeed it could be their sole play. Part of why they engage us is to solicit their business because there's a gap in their aggregate.
Yes, I mean, you're giving them growth as well.
Yeah.
Obviously, we're talking about Mosaic maturing as a business, and presumably you've got ambition to become your own managing agent at some point.
Yes, at some point in the future. The time will be right at some point, and it's probably not that far off. And I genuinely don't know when that will be, but it'll be in the foreseeable future. We need to talk to Lloyd's about it. And
well, for one, obviously, yes, you need permission. And people used to,
yeah, of course.
I remember as a journalist, writing that kind of story was often very difficult because you get a very panicked phone call from the CEO saying, please don't run the story because we haven't actually got permission to do this. Yes, it is our intention, yes.
And that's what I'm gently saying. It's very much our short-term intention. We haven't got a formal application into Lloyd's. Don't read anything into those words. It's something that I'd expect us to do in the very near-term future.
Because I suppose you've got to that scale where, having your own board and having that investment, it makes sense.
Well, and particularly as we continue to grow the partner side, and that will demand sourcing different types of capital as well, and capital from different places. And Lloyd's is very good at providing that infrastructure, I think, be it FAL or coming through London Bridge. So we want to be able to capitalise on all of that work that's been done over the last couple of years.
Yes. It's amazing how many different ways you can slice and dice capital entering into Lloyd's to be exposed to underwriting in one way or another.
But by definition, it was designed for non-trade capital. That's very much its core.
Those particularly appealing. So, but you're going to be exploring all of those and see
all of them. Yeah. We just have to.
Yes, I suppose, because it's just there's just different forms of capital seeking ever so slightly different balances between risk and reward and everything else.
Yeah. And it's part of our product or offering, if you like, to our insured, because what we're seeking to deliver is a very diverse capital base. Yeah. That's the product, and that's syndication.
I've just recently done a podcast with one of the members agents, and they seem to be really riding a wave at the moment. And again, really interesting to be not in vogue, but sort of being remembered as being a very loyal and very discerning source of capital, also a not insignificant source of capital.
Yes, and they're talking to different people as well and different capital sources and institutions. So it would be fascinating to see. But they're certainly very relevant, and I think their demise was rather incorrectly reported. There'll be a renaissance there.
Yes, I would say.
And they really understand the business as well. So for us, I met up with a members agent on Monday night.
You spend a lot of time explaining to them what you do you?
But in a different way. It's certainly grueling, quite correctly.
I think last time we spoke, you said you're a Lloyd's groupie.
Yeah.
We've just had an interesting time at Lloyd's, a renewal of the three key executive positions, CFO, CEO and chairman. When there's renewal, there's always a sort of canvassing period, a sort of, listening to the market type period. I presume you're going to be invited in along with everyone else to be listened to.
I think Patrick's made his mind up already. And that's, that's part of the beauty of having Patrick in that role. He's going to hit the ground running and he's demonstrating that already.
Yes, I think you're right. There's an audible sigh of relief around the whole market, I think, to say, good, there's going to be absolute continuity here. This is great because we already know this is absolute no
and he's inherited the market at a good time. Your point earlier about rate, he's the right man. He used a phrase with me, I'm going to keep a weathered eye on the market. And I think that's just the right tone, as he often gets it right in this sense.
Yes, and certainly one thing that's changed in the last 5 years is the amount of communication. Again, I'm a recipient of that communication. We are invited in every quarter to have the message. It's loud and clear. You can't pretend that you didn't know what the message was because there's one every quarter.
Yeah.
It's very clear, again, in really unequivocal language as well.
And it's difficult to appeal to all the cats without avoiding the herding analogy. But I think they're doing a good job of that. Very difficult. As we all know, Lloyd's is 336 years old.
Well, you're all unique and wonderful in your own minds.
Absolutely. We're all above average. And
there's a lot of being asked, what would you like to see? Then I suppose, what would you say?
Well, as a Lloyd's groupie, I'm not self-professed. I'm not looking for major change, nor do I think major changes are required. There's lots of well-rehearsed points about technology in particular, maybe something less ambitious, something around getting data standardization would be phenomenal in terms of how that would feed into efficiency.
Data Council, for example, those standards exist. Should we just all adopt them and then...
We need to get data standardization sorted as a priority because the rest of technology feeds off that. So there's nothing wrong with being super ambitious, but there's a time for focus. And then fundamentally, 336-year-old institution has evolved to serve a purpose over time. And I'm a believer in institutions. I think you tamper with them in a significant way at your peril. Sometimes there's a big bang that works, but often it's dangerous, and we see that in politics today. I think the pressing change for Lloyds in particular, becoming somewhat circular, is there is this big secular change, and I think the market needs some help with some of the entrenchment. I'm not sure actually that's more for the operators, but we could certainly do with some help around capital, and I think Burkhardt's done a fantastic job there over his tenure. There are still some challenges, particularly around capital diversification, particularly around specialists, and I don't know what the answer is, but I do think about it a lot. There are very few specialists that stay monoline for very long. And I'm wondering whether there's an umbrella approach to capital, because at the end of the day, we've got an umbrella with a central guarantee fund.
Yeah, because 300 different specialists would make for a fantastically diversified book, as long as they're not all specialists in different things.
Yes, but their capital's assessed at their level rather than at the market level.
It's interesting, yes, but you've all got that AA- rating, and that's fantastic. You've all relying on that central fund as part of your chain of securities.
Yeah, I think it's keeping a close eye on what happens as the market does soften, firm eye on rate adequacy, and thinking about how we bring in capital.
Technology. Great thing about starting a company from scratch is obviously you have
One of the great things.
One thing's obviously having a
I don't know what you're going to say,
nice, clean balance sheet. No one's worried about your reserves. It's a load of cash sitting in the bank somewhere. But also these days, and probably more and more important every year, is not having any tech legacy. So you have that nice, luxurious moment on day one of being able to do a sort of beauty parade of all the technologies that are available and picking all the best ones and blending them together, or doing the thing that works best for your outsourcing or whatever. So you've had that benefit. And obviously in that time, with AI has really, really taken off.
Yes.
The problem that you have, obviously, with the legacy companies, we've got to keep the old policy admin system going while we're trying to strike up this new one. And when do you
I think that's one of the entrenched interests.
Things that are really difficult to do. I mean, much harder to do. You can't just snap your fingers and make them work. And you wish you could, but you can't. Obviously, you've had the benefit of having that head start, or just to be able to jump straight to the end game.
Yeah.
What things have worked the best? It's quite interesting to talk to you about.
Yeah. Well, so AI use is absolute key strategy focus for us. And it is a great privileged position to
some of those classes, and something like transactional liability, where it's just got reams and reams of documentation.
Yeah.
It must be great having an AI that you can
train
it to read.
And we have done so, and we rely heavily on it for submission triaging. We think about it in two pillars, very simply. One is process, and one is enhanced risk selection. And there are so many different interests across the different groups in our firm, very much by intent. And when you bring our insureds in, our capital providers in, our distribution partners, ultimately, I think the one thing that we can all coalesce around is risk selection. And what the future looks like there with the benefit of AI is just extraordinary. And particularly in terms of, to your point, the available data, working out what the best data is and how it correlates with operational risk. And we are already doing some really amazing things there, which I'm pretty sure is impacting our loss ratio. The two most exciting partnerships we have are in cyber. One is with Safe Security, and the other is with Fulcrum Technologies. And they're very different businesses, and we're targeting very different size businesses. But in distillation, what they are doing for us is providing us data-driven models, but based on audit, inside-out view on the likelihood of loss and the cost of loss against the prevailing threat environments. And one of them is Fulcrum is a much broader digital security provider, so we form part of the response. One of the really interesting points behind this is the digital security industry is worth over $200 billion. And the cyber market's about 16.5. We always tend to think we're the center of the world when it comes to risk, and we're 7 or 8% of what the buying clients regard as a solution. So I think partnering with other people who are providing solutions is really interesting. But the main point there was having this assessment of likelihood and value for an underwriter is just extraordinary. And it's very objective.
The interesting thing that's happened with cyber, that development into that insurance being part of a prevention as well as a cure. And funny enough, sort of going back almost to the original insurance of the insurer actually owns the fire brigade.
Yeah.
We are the fire brigade as well as the insurance company. And these things are perfectly aligned and they've always worked really well together. Cyber's gone that way. Do you think as we digitize, for example, as you get so skillful at picking the cherries out of the submission flow, you've got that methodology and you know why that is a good risk and that is a bad risk. And you can then explain to the bad risk people, I don't really want to do this now, but if you solve this problem that I know you've got, you say, well, I will insure you for this price if you do this thing.
That's part of the dialogue that we have.
So again, you're making your market bigger and hopefully you're growing a market with more cherries in it. That you can pick.
Yeah.
And obviously it's good for the client.
If you take safe security, their quantification is very objective. We can correlate that with our pricing models. We can have very transparent conversations with CISO and the risk manager that if you do this, then this will happen to the price. And that's really interesting. But part of what I really liked about your intro to that, and one of the things I really love about SAFE is going back to the stamping the boiler at Factory Mutual, if you like, sort of thing. Whilst they sort of do that, which is very interesting in and of itself, their client is the CISO who will be working alongside the risk manager when they engage with us. But the real client's the CISO, and they're not providing anything else. So they're giving the CISO very objective loss environment info. And they don't have a solution. So the CISO can go to the FD and say, look, we've got this risk. So it's a board to say, how much cyber risk have we got? That's a wonderful tool. But it then gives them a choice because the CISO can say, we've got this exposure, we can pay this to patch it, we can insure it, or we can run it. What do you want to do? To the board, rather than, I don't really know how much exposure we've got, but this company, which is peerish, buys this much. It's a completely different.
They're much more sophisticated.
So much, and so better involved.
Do you think more classes, as we get more sophisticated, will be more like cyber? I suppose cyber's easier because by definition it's very sophisticated before it started.
I think they will. One of the other projects I'm really super excited about at the moment is with a young startup called Canongate, who are doing a similar thing in terms of assessing how much risk is there, what's it going to cost in political risk. And that's through just massive data absorption. And they're at the moment trialing what the lead indicators have been to political disruptions. I think over the last decade, I could be wrong. At the moment, they're pre-testing where the data went to and looking for those correlations. At the end of the day, I want to get an objective view on risk. And Mitch and I feel that a primary obligation on us and the companies to provide our underwriters with better risk selection capability. And that would be one reason why people would want to work here. And it would be another reason why underwriters would want to underwrite alongside us. And so it keeps coming back to risk selection.
Last thing I want to ask you is about the risk of the technology itself, AI being misused, not used properly. And obviously, again, that feeds into a lot of the classes that you're writing, class for, professional indemnity type with financial institution, these sorts of risks where, they've adopted an AI and they've forgot that sort of the sorcerer's apprentice has gone a bit mad, the place is flooding. What do you think about that in terms of the insurability? Again, one presumes that's going to tick a lot of boxes in terms of a class.
Yes.
It's definitely going to grow. Demand's going to grow.
It most certainly is.
I suppose it's already in there. It's silent at the moment.
Yeah, exactly. And that was going to be, so I was going to say, without being facile, it's already there. And the exposures are already there. And it feels, I think about this a lot, it feels it's more like a products type liability in terms of, how we'd think about that in old-fashioned terms. It's just going to happen a lot faster. It's much more interconnected. But I'm sort of reserving judgment until we get guidance. Governments all over the world are thinking about this, and they're going to prescribe liabilities, and the industry will respond to that. And it's a really exciting opportunity for us.
Mark, thank you so much. I can't believe, yes, it's been a couple of years, and I'm already looking forward to talking to you in a couple of years' time because, again, I think the business will be different.
Yeah, me too.
We'll have a lot to talk about, which is good.
No, it's always fun chatting. Thanks for inviting me back again.
No, thanks for coming on.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects.
Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry.
The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass.
Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.